Thank you all for coming live, and thank you for all of you who are online. I appreciate you coming today. So I labeled or I titled this class, this lecture, Keys to Building a Successful and Sellable Startup. Dave Mulwiney and I, years ago when I started doing this, it's gone through a couple of different, but we kind of stuck with this because when we go through, and we'll go into a lot more detail, so often your initial focus is what's the product, which absolutely. But one thing that many of you probably know, that as soon as you start thinking about starting a business, you kind of have to start thinking, what's your exit strategy? So I'm going to focus today on some things that might not be on top of your initial thinking, but in my opinion is incredibly crucial to actually getting to a sale. And it is digital organization and cash flow forecasting. And to most people, that probably looks like the most boring topic in ideas ever. I can't always disagree, but what I can agree to is if you don't do this, they will come and haunt you. So I came up with this thought after probably maybe after a second sale when we were kind of going through the process. And to be fair, this is anecdotal. I've not gone through and done any official studies, but I've talked to numerous entrepreneurs, and pretty much at the end of the day, they've all agreed to it. So my audacious thought is simply, with accurate forecasts and organized files to back up the cash flow, you are really about at least 75% of your way being prepared to sell your business, your company, or your product, which sounds very strange because it should be about the product. But what I'm hoping by the end of today, you have a little bit better insight of why I feel this, because this is not ignoring the importance of the product. But what I'm saying is without these couple of things being done from day one, it would be a much harder and more difficult process to get to a sale. So briefly, Allison kind of gave a high-level background on my professional life. Don't need to go into much more detail, but the only thing that I do want to add is right out of college, I started at PPG Industries in their financial management development program. I then got accepted to come to Carnegie Mellon for my MBA. And, this was many decades ago. I had a bunch of money saved up, and I was like, wow, I'm still going to have some debt. And so I was living in Kansas City at the time with PPG. And so I just started looking around in Pittsburgh, like maybe I can work and go to school at the same time. Well, I was very fortunate to find a company that you've already heard of today called Respironics. They actually brought me back in 1991 as their cost accountant and offered to pay for my education. So I said, yes, I will do that. So I flipped into the flex time program. It was really 3 very hard years, especially during those times at Respironics and our growth. But what I didn't realize was that was my first taste of entrepreneurialism. At that time, weirdly, in 1991, Respironics was a public company with $36 million revenue sales. That will not happen now. But this was pre-Sarbanes-Oxley. There were much cost to be a public company. But so even though we were a public company trading on NASDAQ, again, we were $36 million, but we were growing and growing fast. So that's kind of when I got my entrepreneur company. So I stayed there, or entrepreneur bug. Stayed there for about 10 years. And when I left, I then went to a few other different companies. And I kind of got into this track record of kind of being the CFO, helping to grow a company, sell a company, grow a company, sell a company. So sovaSage right now, who's the founder, someone that I worked with at Respironics. So we're still we're not doing a fundraise right now. We're looking at kind of our next steps. Maybe a year from now, do another one. But I have helped to sell 3 different companies of different sizes in different industries and in 3 different ways. So when I talk to, so this presentation really came out of my living experience with these companies, going through growth, bringing on capital, going through the hard times, getting through them, and then ultimately selling. Now, the big thing on this is, even for the people online, I have a presentation and I can talk through the whole hour. That is no problem. But it's more important for me for this to be interactive with you. You're spending the time here. You've chosen to take an hour out of your day to spend here. And there was a reason why you did this. So I'm calling this kind of the whys and whats. I'm presenting these two things together. I've already hinted because these are things that most entrepreneurs don't think about on day one when they're starting a company. And that's okay. Maybe it shouldn't be day one, but it should be actually shortly thereafter that these two things, being organized and cash flow, need to be coming into your thinking. Not that you may have to do anything or do a lot of detailed work, but it needs to be up there soon. So my question though to you right now is, and I want to kind of jot this down if anyone has, why are you here? What are the things that you hope to learn? Why did you sign up? What are some of the topics that you want me to address? And what I'm going to do is I'm just going to kind of write them down on the side, one, just so that I can make sure that by knowing this even ahead of time, when I get to certain sections, I can make sure to cover. But then at the end, I want to come back to the questions and make sure that I've answered everything, that I didn't miss anything, because there may be some information I can add to it. So just kind of open up the floor, open up the Zoom room. Why are you here? What are things that you would like to hear, learn about, or for me to talk about? Doesn't have to be anything big and huge, but you obviously came here for a reason.
How does this vary between businesses? So like a hardware company versus a software company?
Right. Okay. Yeah.
Something I was working at Startu for the past 1 year, and we were dealing with this company called Medicine, which makes a lot of these CBD oils for pain relief. And there's a lot of red tape involved with such companies.
Yeah.
And so it's gone in a lot of debt now, and we're trying to bring it back. And that 1 year trying to bring it back up was very difficult, and it was very difficult to understand how the market would evolve with the product, right? And which is why I think sessions like this could help us kind of figure out what are the building such business.
So the question is, and I apologize, the first one, I didn't repeat it, but the first question, in case it wasn't heard, was how can these two topics help with different types of companies, hardware, software, other industries? Similar, so that was the first question. The second question, somewhat similar, is then how do you deal with companies that maybe have that are more regulated or that have harder kind of barriers to entry to getting to profitability? Is that a fair? Yeah, it's that. I'm not writing the whole thing down. These are more like so that I remember. So I'm just going to say regulated companies. And I know yes.
This is more so based on what you shared about your experience. I'd love to learn more from you about how do you know like a company if to help them make that decision whether or not to sell or to keep growing. And then on the other side too, it's like how do you know if it's help the companies understand if it's too soon for them to sell?
Okay, fair enough. So I'm going to say time to sell with big question mark. So the question was how during this process, are there any red flags or any indicators that can help a company decide when it might be time to sell or when we need to maybe continue to raise money? What are some of the factors that would go into those kind of timing decisions? Is that a fair? I'm just going to write time to sell, and I'll say versus invest more. Anything else? And again, as we go through, please raise hands or let Allison know online with questions because things may pop up, or feel free to save to the end. But yes. Yeah. Yep.
Sell it. So if you could talk about like more on the personal founder side, like when and how that.
Yep.
This.
Yep.
This.
So the question was, when a founder starts a company, in many cases, they may already have kind of an exit plan in place. So how does that get incorporated, or how or when does that need to change? Okay. All right, well, we'll get moving on. And again, feel free to ask any questions. And these are great questions, and I should be able to hopefully address some of them, at least during the meet or during the lecture. And if not, at the end, we can dive a little bit deeper into it, especially if you have some kind of more refined questions. So why are any of you starting a company? There are many reasons why someone will start a company. A lot of it may have to do with where they are in their life. Some people, they want to get out of big businesses. They just want to have a company to make money, to have a lifestyle that is a little bit more control. Some people then therefore just want to stay in business. They're not looking for an exit strategy. Maybe their exit strategy is to pass it on to children or to somebody else. However, that's not everyone. Some, they want to grow, and that growth can come through organic, adding new products, doing acquisitions. Some, as we alluded to, and many of you, they want an exit. But what is that exit? Is that exit going to be to a venture capital, private equity? Is it going to try to go public? Is it going to a strategic partner? There's a lot of different things, and a lot of that will end up evolving as you go through the business. But you do start thinking about that in many cases. But during that, under like even maybe grow the business organically or through acquisition, even before you get to a sale, most likely you are going to have to get money. And that money might be, if you're fortunate, there might be family money. You might have friends who can put in. But most likely at some point during the majority of companies, they're going to have to start talking to bankers. They're going to have to start bringing in outside investors. And when I say outside investors, maybe not known to you, not your friends and family, not your classmates. So all of these are true, whether you're for a for-profit or a nonprofit company, because some people will start a nonprofit group. Well, guess what? All a nonprofit means, it's a tax code. That just means at the end of the day, you don't have stock options. You don't have like investors putting in shares. You still have to make money because you still have a service, a product, or employees to pay. So I would argue that whatever you hear throughout this entire day, whether it would be true for any type of company, for profit, large, small, regardless of industry. Now, when you're starting a company, even if it's just because I had a friend of mine, her husband, he wanted to get out of the business and he wanted to start a company. Now, he ended up doing a franchise, but the point is, his goal was he wanted to make money. He didn't necessarily care what the business was, what the industry was. Many of you might have a product idea. It ultimately does not matter, doesn't matter what you do, but what matters is that whatever product or service or idea that you have, is it solving a problem? I'm calling it's a good and needed product. I don't know how, good is defined by the market. Good, in my opinion, that means it's a disruptor. It's something different. Many of you may have learned this in any entrepreneur class, that if you're going into an industry, and let's just say it's a $10 billion industry, and you're like, oh, if I only get 5% of the market, that's not the goal. The goal is, if you have a product, what are you doing to get to 5%? You don't, just by making a copycat does not guarantee you. Yeah, maybe you have better marketing, maybe you have better distribution, but now you have something that's better than a competitor. So when you start a company, that has to be your initial focus. There's no question about it. Then once you have a product, Now you have to bring in, or a service or an idea. Now you have to bring in the right people at the right time. And when I say the right people at the right time, is because you have to look at, start thinking automatically now about cash flow. How are we going to pay them? But maybe they're friends. You're going to figure out, all right, how am I going to build this product? How am I going to sell this product? And then at some point, you're going to sit back and go, oh no, I need to deal with all of that other, I call it the back office stuff, the finance, the IT, the admins, if you have facilities, if you need legal help, if you need insurance, all of those, and I can say this because this is kind of my area, we're the annoying ones to entrepreneurs because we have to have, and we tend to not be viewed as the fun ones. But if you bring them on early and you bring on the right people, they can be fun in the sense of we can be here to help you with your business. However, even before you're doing any of these things, you have got to be organized. Now, look, that sounds, again, I'm saying it may not be sexy. This is not something that you think about. And I'm not, I'm a huge Friends, the television show Friends, and there's a character on there, Monica, who is like OCD with this labeling everything. I'm not saying you need to do that, but we're going to go through in a minute here about what you need to do. The reason why you have to start from day one is because it's easy. And if you want to get to a sale, you need to have all of this documentation ready. I have had two separate entrepreneurs tell me, and they know each other, but they did not know, they told me both basically the same thing. After we were going through a sale process for one of my companies, and my CEO looks at me and goes, Kelley, if I ever do this again and I hire you, your sole job will be to walk around carrying a bat and hit me on the head if I don't save fill in the blank. Separately, and another company said basically the same thing. Goes, oh my God, I never knew how hard this was going to be. Where is this stuff? Why didn't I think to keep all of this? So two separate people saying the exact same thing. So what do you need to keep? And this again is from day one. First is what is called the organizational documents. So if you're creating an LLC, you're creating an S Corp, you're creating anything, any documentation to do that, you have to keep. You have to keep any investor agreements. You have to keep any banking agreements, your tax documents, board meeting minutes, audits. These are absolutely positively must keep. You also have to keep anything about your customers, your vendors, your consultants, your employees. Do you have NDAs, your I-9s, contracts, agreements, offer letters? In my last bullet point here, and I'll say all of it, even for ones that are no longer with you. And this is for, say someone moved on, or you let somebody go, or you only use a contractor one time. For liability reasons, you need to keep these somewhere. The product, your service, your process. When you're creating these ideas or you're creating your product, you are going to have documentation. If it's an actual product, a hardware, you're going to have a bill of materials. You are going to have the things that is your intellectual property that helped create. You keep it all. The other thing, like the company I'm at now, we're going through HIPAA certification. The company I worked at before, we went through SOX certification. You will go into different industries that you may be going through some type of certification so that you can put the old logo on your website, or it's a customer is demanding it. You want to keep all of those. In many cases on that certification, you're going to have to go through annual audits anyways. You keep every audit. And the reason why you keep all the documentation throughout the year, so that when the audit comes, you can basically hand them a file and say, here you go, versus them coming and say, where's this? They're still going to do that. But by doing all of this, it will make your life on a day-to-day basis easier because you have the document. Just put it somewhere. Just don't hit delete. Now, what I would argue, and we'll get to this in a minute, is try to keep some organization, and we'll get to that in a second. So these are the things that you, no question, have to keep. Now, there's also some stuff that you really should keep, because it will help you not only run your business, but it will help when you are bringing in investors and sales. When you do any budgets, and these can be simple spreadsheets, they don't have to be anything fancy. When you do run monthly financials, you're going to have different metrics, different KPIs. When you have investors, you're going to have random meetings. You keep your minutes. If you're questioning, should you keep it? Yeah, keep it. And the beauty of now versus like 20, 30 years ago, I used to have the largest office in the company because as a CFO, and you kept all of this stuff, that was in binders. That was paperwork. I can't even tell you. I mean, we would have rooms filled like this with all our accounts payable, accounts receivables, all of that stuff over the years. The beauty now is you can keep it on a hard drive or I use a WD passport, something that this big, and you can have all the gigabytes that you need. So if you're not sure, you keep it. So the reason why you're keeping it are for all of these things. Remember how I told you that when you get to a sale, if you have done all of this, that it's 70, you'd probably be 75% there for getting to a sale. Anytime you go to a sale, or like we did a convertible note round last year. Prior to that, we had, a Series A round. The people who are investing in you, especially if you're getting to venture capitals or you're using like a Ben Franklin or around here in Pittsburgh, IWI, they come out and basically copy paste. They send you the list of everything they need. Not everything you'll have, but they want everything. And the reason why they want everything is because they want to know if we're buying you, we want to make sure there's no liabilities. We want to make sure that you know your business, that you understand your customers, that you understand how, what your customer needs are, what your employees do, your quality of earnings. So in other words, the earnings on your spreadsheets, they're real. I can see customer invoices that back that up, and that customer invoice has a contract that's signed. Great, done. We're all good. And when you get at the very end, one of the things that I say often, no company, trust me, I can think of highly of myself and what my department does. Nobody buys a company because your finance department is the best they've ever seen. That will not happen. But what does happen is during the sale process, we keep the sale price because what happens is, and if any of you have ever gone through a sale before in the past, when you do a memorandum of understanding or of a letter of intent to someone to buy your company, let's say they throw out a number of $50 million. I'm just saying a number. So they say you sign a letter of intent and you guys are all like, woohoo, $50 million. Well, they now come in, their investment bankers come in, their auditors come in, all of their people. Their goal, they will never tell you this, their sole goal is to bring that price down. They will, and they do that by saying that, oh, here's some risk, here's some liabilities. Oh, that operation, those operations have some questions on it, that capital question. By doing all of this, you will keep that sale price. Because the one thing I will say about me, whoops, sorry, keep going back, is that every company I've sold, we've never, ever gone below that initial sale value. And in fact, in 2 of the cases, we went up. And the reason why was because we were collecting our sales. We had, I won't go through all the details, but there's a process that you go through where you have to look at working capital. You have to do this huge reconciliation. I beat it every time. And the reason why is we had all of this stuff. And the biggest lesson is this last one. If you start and you just start doing this from day one and you just keep doing it, then it's easy. You don't think about it. The issue comes the moment when you decide to bring on investors and they send you the Excel spreadsheet with 10 tabs, and each tab has 30 different requests on it. It's still going to be a pain in the butt because you have to organize the war room and organize the files, but you have everything. So this does not have to be a big deal. There's a lot of free or low cost options. Google Drive, SharePoint, Box, Dropbox, OneDrive, whatever you have. But you need to be organized. And that's where I would argue that you keep the folders. And even if it starts with financials, tax stuff, whatever the high level. And then as you go, you'll probably make some subfolders. And there's also a ton of other options out there, especially that are more specialized, like for HR or for like board meetings where you would pay. But you can, that is one of those things that evolve. I think you were raising your hand or,
Yeah. Uh,
nope.
Not tonight, you just mentioned the environment, is that, we're talking about acquisitions, right? So.
Yep.
someone's gonna buy or say.
Yep.
"Oh, we'll probably pay this, or we will pay this.
Yeah.
And they actually do this.
Correct. Yes. Yes. Yeah. And that's exact. Yeah. Because a letter of intent is usually, if you've ever done it, one, probably 2 pages max. And there's all kinds of qualifiers. So it'll say, hey, you know, based on the information we currently have, you know, we'll, you know, be $50 million, but now we have to do this, you know, these processes. So that's exactly right. Now, so that's kind of the first part, is that being organized. Again, not sexy, doesn't have to be hard, save everything. The other reason, and I've already kind of hinted at it, the other reason why all of this stuff is important, and you'll see her momentarily, is just about every document you save will help support your cash flow. Period. So when I was a student here, we had one of my favorite professors, who was Dr. Richard Green. He unfortunately has since passed. He used to say, debt is good. And what he was referring to was kind of debt versus equity. He was talking about dilution. He was talking, you know, different. But at the end of the day, I'm kind of renamed it to cash is good. And the reason why, and I'm sure you all know this, is most companies don't survive simply because they run out of money. Not necessarily a bad product, not necessarily that the customer doesn't want it. They maybe grown too fast, or they underestimated certain costs and they run out of cash. So one of the things that I know, and we'll talk a little bit about this when you're forecasting, is you always want to forecast your expenses too high and your income too low. AKA, you need to be conservative, because what always happens is the dollar amounts might be correct. The timing tends to always be the issue. Customers pay a little late, but guess what doesn't come late? Payroll. Payroll happens when it happens. Your rent happens when it happens. Your customers are going to pay you. So you always need to have that cash on hand, regardless whether it's coming from equity or debt. I'm a finance major. I've had responsibility for HR, for, as a CFO, I have kind of the responsibility for all the things that all the entrepreneurs don't want to deal with. But I'm not going to lie, one of my early babies and has always been forecasting and budgeting. To me, that's like my Zen. It's easy for me. I get it. I understand it. To so many people, there's this fear of doing a budget because they see, and I can show you later, I can create some really complicated budgets and forecasts. The reality is it doesn't have to be. It can be so incredibly simple, especially when you start. And then what happens is it evolves over time, but it happens naturally. But you need to start this immediately. And this coincides with doing a budget. The two can be one and the same. If you've taken any accounting, you've heard the term EBITDA. EBITDA is basically, it's not a one-to-one to cash, but it is a version of looking at cash, which comes from your budgeting. So I'm going to show you a couple of different models. One that is using the EBITDA model, one I call operational, cash in, cash out. Nothing more exciting than that. When you do these budgets and you do these forecasts, the big thing is you really want to have it rolling into the future. I mentioned in here that, you could have even an 8 to 13 week rolling cash flow. So years ago, I was at a much larger, it was like a $500 million company. And this was in 2008 when there was a financial trouble. So when we were doing weekly cash flows, fortunately, I haven't had to do too many of those since then. But the big thing is you really need, especially if you're doing a monthly one, you really want to have a minimum of a 12-month lookout. And probably a 24-month would even be better. And it needs to be rolling. And it's not worrying about that a year from now is dead on perfect, but what I'm going to hopefully show you is you need to see what the forecast is looking like. You need to know when you need to start raising money. And that's what I'm going to hopefully show you in some very, very simple ways. I have a thing here called Money Monday, just as I mentioned before about being organized and you make it a habit of saving things. Every Monday, I basically do kind of a cash reconciliation forecast. Sometimes it takes 10 minutes. It's nothing, but it's looking to making sure that what you have in your bank account equals to what you have in your your accounting software, QuickBooks, SAP, whatever you're using. And that also makes sure you kind of take a look at making sure your customers are paying you on time, because what happens is you get busy doing all these other things and you might be like, oh my gosh, this person's now a week late, which isn't horrible, but you want to immediately get on it, because if you wait another couple weeks, then by the time they send it. So basically, I've been doing Money Monday for I don't know, I guess 20 years. And again, sometimes it's 10 minutes, sometimes it's longer, but it's part of that habit. And then by doing that, then I don't worry about it for the rest of the week, unless there's something that triggers. But by doing it, remember how I told you that's kind of doing budgeting, forecasting a little bit of is my Zen. That tends to be one of my Monday morning things. You're clearing emails. I just do this. I get it out of the way and it clears my head that I can move on to other things. The hardest part about forecasting, and I alluded to it a little bit beforehand, is about customers, is when you're doing any type of forecasting, it's easy to budget expenses. It's easy to budget payroll and credit cards and your rent, because you know when they are and you know how much they are. The challenge is always with customers, and when is a customer going to sign? So one of the challenges when you're doing forecasts, especially in a growing company, is when will you actually sign the customer? When will that customer actually start paying? So one of the things as you go through this is making sure you have to learn your salespeople, even if it's you, and learn your industry. So as you do forecasting, you will get better at it. And this goes back to that conservative, that if you think, oh, I should be able to sign this customer in 3 months and they'll pay in 4, yeah, I would make that 6 and 7, because things happen. So it doesn't have to be hard, and I'm going to hopefully show you that. But these are just some basic things to always just keep in mind. So I mentioned two types of cash flows, and these are not accounting. There's the old statement of cash flows. This has nothing to do with that, because truthfully, I shouldn't say this out loud, I find that worthless, but that's part of an audit. That doesn't help us. That helps us a different thing. There's two ways: an operational cash flow, and this might be something you even do on your own personal, if you have jobs. It is simply cash in, cash out. It's no more difficult than that. When am I getting paid by my customers? When am I getting paid by personal or future customers? What money am I bringing in from investors or banks or any other? Cash out, what's my payroll? When do I have to pay rent? When do I have to buy equipment? When do I have to buy? It's simple as that. It is not hard. I mean, that you probably, whenever you start a business, this is budgeting. I mean, this really is all budgeting is. Now, a second way to do this is if you do have kind of a more of an elaborate budget, like what I have right now at my current company, I have a big budget. Well, my company, we invoice our customers on a monthly basis. So revenue is somewhat of a proxy for cash in, maybe a month later. So I'm able to use EBITDA as my cash flow forecast, but I just move out the revenue 1 month out, because I'm just going to assume that everyone pays kind of a month later. And my expenses are the expenses for the month, because it's primarily payroll. So cash out is my expense. And then I have rent and insurance, and then there'll be other things. So if you've gone through and you have a big budget and you have this consistency of payments, then you might just need to just do a forecast in EBITDA. And I'll show you that format also. So on the operational one, you can use it also the cash in with consistent, but where this is really helpful are for those customers who do annual payments or maybe quarterly, or there's that longer. Because, and the reason why is, let's say you get a customer, let's say, for example, I was in an industry where it was the education and higher ed, and most of their budgets start on July 1. So most of our contracts started on July 1. So the bulk of our cash came in between July and early September. So that cash had to take us through the entire year. And so that's why I needed that cash in, cash out. We might have a few that came later, but I had to make sure and not be like, woohoo, look at all this money we have. Like, yeah, that has to last for the year. So those are kind of like two different ways, whereas the EBITDA, that would not work. All right, so now let me, glasses on. All right, so the first one here, so this is the operational model. So this is simply cash in, cash out. And what you can see is we have the, let me go over, whoops, activate. Wait, what is that? Nope. All right. All right. How do I get out of view only? Do you know? Because I just want to move, because I want to move around. Okay. Got it. Okay.
Yeah, it should.
Thanks. All right, perfect. All right. So what I'm showing here, you can see it's very, very simple. You got cash in, cash in. You had some customers, the investor money. I have a line in here. Then I'm just showing you payroll, healthcare, other benefits, rent, insurance. I just try to throw in some different things. You can see when I do it, I then make sure, like, here are my actuals. So this is something that I'll update every month when I close out a month, so that my forecast includes actuals. And then also by doing that, maybe I'm seeing a trend up or down. Like a classic example I'm going through right now with my current company, our software with AWS. Well, I had forecasted growth. Well, it's growing faster than I had forecast. So I had to reforecast that line because the expenses were coming in because that and the Twilio, which is a messaging service, we're having a lot more of that. Yes. Say that again. So the monthly burn is basically the net amount of cash in versus cash out. So so on here, the cash, so you can see that in here, I'm showing that, well, I'm still showing that this is probably more of a startup type company. I tried to do this more as a startup. So right now I'm saying that you're burning more than you're taking in. So what's going to happen is, see my cash, I started off with a positive cash balance because I probably had, some investor money. So let's say I started the year at 400,000, but I'm burning through cash. So my forecast, what it's showing me is that and I didn't do a good job with so this is August. Sorry, I did a bad job with where I put the frame. So what I'm showing you is in August, I'm going to be out of money. So what I will hopefully have already started doing is I would have started trying to raise money. So you can see, again, I've just put in numbers here. I'm just doing this as some examples. So I have some cash coming in here. But the point that I'm trying to show here is that I'm going to eventually need more money. And this is why you have got to do a rolling 12-month forecast. Because let's say here, let's say I put in 1 million. Whoops, one missed a zero. All right, what's going on here? All right, so if I typed in, if we had raised $1 million, you can see by the end of the year, I'm still good. But this is allowing you also to kind of play around with, like, let's say this was at the beginning of the year. Whoops, you don't need that much. It can show you that basically you're going to be almost break even by the end of the year if you had brought in, say, $500,000. Oh, wait, did I put in another? What did I do? I put something else in wrong somewhere. I did something else wrong somewhere. Anyways, did I not? All right, it's still showing that I put in 5 million. I don't know why. Anyway, anywho, so I apologize. This is not liking me. I don't know, because it's the view only. There we go. So this is simply cash in, cash out. But you can see though, I have some other tabs down here, customers. So what you'll end up doing as you're growing is you may want to put in, all right, I am not doing well here with this. There we go. So I have signed customers and I have forecasted customers. And this is where you can play around. So here I'm showing you a customer that would pay monthly, a fixed amount. You can come in here and put in that they pay once a year. They could put in different amounts. Then I have one here that shows me my payroll. And so this is showing me, here's my current employees, here's forecasted employees. I have all of those tagged into here. So what I'm just trying to simply show you is that you can make this as easy or as difficult as you want. When you're starting, my guess is this one page, because it could probably be you and a buddy, maybe even you by yourself, and you're just going to start writing things down. And you can put it in as much detail as you want. But now you're going to hire someone. Now you're going to do forecasting. That's when these tabs, I tend to add them in tabs just to try to keep this one as simple as possible. This is what is called an operational cash flow. Cash in, cash out. The EBITDA one, I have so separately, and this is pulled out of, the way I do it now is I have a big budget because I have departments, we have a couple different product groups, and then I have a single cash flow, and all of these are adding from those different tabs. So I'm pulling my EBITDA from my budget. So this one, I almost do nothing with, because this one here, because the budget is doing all the work. When I'm updating the budget every month, then it flows right into my EBITDA. But this one, if you want to use EBITDA, this is the one for sure when you're going to have consistent revenue, because the only way to use EBITDA as a proxy for cash flow is if the cash coming in is really for that month. If you're getting a large annual cash influx, that's not EBITDA, because EBITDA basically that is going to be that number divided by 12. Does that make sense? So simply what I want to show you is that the cash flow can be as difficult or as easy as you want. But I think close this one. But when you're starting off, creating this simple cash in, cash out is really the way to go. You can do it on a piece of paper. You can do it on a spreadsheet. You know your business. But what this is going to require you to do right from the very beginning, kind of going back to if I have a product or hardware, you got to now call vendors. You have to now call people to find out what are those things going to cost, how much. So this will force you to start asking this question. Oh, now I have to hire some contract software people. Oh, I have hardware. I need storage. This is going to force you to start thinking about what are all the things that I'm going to need to get a product out the door. And oh, by the way, now I have to call potential vendors or potential employees or potential contractors to get what those costs are and find out that timing. So these are the couple models. Again, we can come back to it later, but my point on this is it can be very simple. It does not have to be difficult. All right, okay, I did it again. All right, I might need your help again. I just want to get back to the presentation. Yeah. There it is. Okay. Thank you. Sure. Okay. Now, one of the things that I kind of started doing a little bit when I was screwing around with that 500,000 and the 5 million, and you could look at different timing, is that's called scenario planning. And what's important with that is, especially like when we're showing new customers and the timing, you have to understand what are the various levers that you can pull: hiring employees, bringing in equipment, bringing on new customers. What are all the things that go into that budget or into that cash flow? Those are your different scenarios because you need to understand what your runway is for cash. You need to and this is why you need to do that 12-month, 18-month, because you need to understand if I need, like, for example, I forecasted 2.5 years ago that we were going to need, my prior company, we were going to need money by July 1 of last year. And I was correct within 6 weeks. I was on the conservative side. But we started that fundraise in like November, December to make sure to close by May or June, because that's how long some of that takes. Unless you have, you have a spigot of money that you can turn on and off quickly, you've got to give yourself that plenty of time. And by doing this forecast, by putting out that 12 to 18-month rolling, this is what's going to give you that idea. And that's why you want to play around with scenario planning, because you can say, well, what if I put off that hire? Well, what if those customers don't come in? What if my sell price changes? So those are the various scenarios that you need to look at. And then eventually, when you have maybe more traditional banking, and you'll have covenants. So for example, if you take out a traditional loan from a bank, they're going to require certain things, a certain amount of cash, a certain amount of accounts receivable, certain amount of contracts. And if you blow any of those covenants, they'll put you in what I call the doghouse. And with that, they will restrict some funding and they will restrict some of your spending. You don't want to go into the doghouse. It's not a fun place to be, but many companies have been there. But by my doing a cash flow forecast back in the 2008, 2009 timeframe, I forecasted back in June that in November and December, I was going to blow a covenant, but in January, we were going to make it. Because of that, and all my forecasts were correct, we did not get put into the penalty box or the doghouse because the bankers knew. They're like, oh, okay, you warned us ahead of time. And all my numbers were correct and they were fine. So that's why you do all of this. Because go ahead. Yeah, so every bank can be different, but a lot of covenants, what they will look at is they're like coverage ratios. What they want in the end, the bank wants to make sure that you can pay them. And so when they made an investment in you by loaning you money or even doing a line of credit with you, they are going to look at your ability to pay them back. And they're going to look at basically what's your accounts receivable, what is your debt coverage. So in other words, what is my how much kind of cash do I have available, or what's my net income over my debt? I mean, so there's the different ratios that they will put out just to make sure that they are comfortable that you will have and continue to have the ability to pay them back. Because in the end, they're not investors. I mean, they are, but kind of leading into this, even though a banker is not an investor, and a lot of times entrepreneurs will sometimes view bankers as, I don't say the enemy, but as mean people. You want to have a good relationship with the banker, because what I can tell you, remember that scenario I told you, that banker did not put us in the penalty box because we had a good relationship with them. I met with them quarterly. I shared the information. I brought in different people from the company. They got to know us. And by doing that, they actually wanted to help us more. They actually introduced us to potential investors. They actually gave us some, got better, interest rates. So you're doing all of this because you want to show your bankers, you want to show your investors, your potential investors, and quite frankly, you want to show your employees who are there, or maybe a new employee. Let's say you found a hotshot software developer that you're trying to convince them to come. Well, they're going to want to know, like, is this company worth it? Like, are they going to be here a year from now? Can they pay my salary? So by doing all of this, by gaining each of those people's trust, by showing them that that you know your business, that you have the forecast, and that you're following up on the forecast, you're meeting those forecasts, your ability to raise money to sell goes up incredibly, because at the end of the day, it is about the people. yes, there's a product and but when they're buying, they might be buying the product, but they're also buying the people, and they want to know that I hate saying, I don't mean by buying the people, but when they're buying a company, they're bringing you on, and they are bringing on your talents. So during COVID-19, so these are a couple quick examples. During COVID-19, the world shut down, everyone was so concerned. So I had all of this detail. So we were basically meeting with our board, just like many companies, once or twice a week. After 4 weeks, I was uninvited because they're like, oh, you know what you're doing. We don't need to spend time on this anymore. And so I would just send them information, and I was getting them monthly because they were fine, because I proved to them. And therefore, that was good. They weren't having to waste time on me with my cash flow forecasting, because they knew that I would come to them. So they were able to worry more about making sure our customers were good and selling the products. I've already talked about that breach that we almost had, we did have, but I forecasted it 6 months ahead of time, so the bank was fine. They were like, good, great, we see it. It wasn't like a severe breach. And then the last is, and I kind of alluded to this before on the sales side, but whenever you're bringing on a new product and new anything, I tend to multiply everything by 3. So if you think that it's going to take 3 months to get it to market, yeah, it's going to take 9. If you think it's going to cost $100 in the beginning, it's going to cost $300. It will eventually get to 100. It'll eventually get to 3 months. But the first of anything, these are just my experience, I tend to multiply by 3. It might be high, but I'm never too high.
Did you tell people working on that this is your new time?
That's a great question. So the question was, if someone tells me that's going to take them 3 months and I'm going to project 9, no, we still that's a great question. So you'll have those different scenarios. So no, that's not true. I may tell them, look, on my scenario, I tend to do a worst case scenarios. And I may have, for that, I may have the worst case, and I may have an expected, and maybe I don't do it 3 months. Maybe it's like, 4.5, 5 months. But it's a great question. No, you can do both, because there are operational goals that manager would have over those employees, saying, no, we need to get this done in 3 months, because sometimes the delays may have nothing to do. It might be regulation. It might be we have to go get a 510K, or we have to go get certain certifications. So they've done everything they could. So I may tell the high level manager, and maybe you do share, but you have to still keep them on. And that's where the employees can be on their own timeline for their own annual reviews and their bonuses, etc. But what I'm doing for this, no. I mean, that the board and banker, they want you to be on the conservative. Now, they don't want you to sandbag it. They don't want you to be like, oh, our revenue's not coming in, but in our expenses. I mean, there has to be some level of realization. And so for me, 3 months work. Other companies or other industries, it might be different.
You said that in our minds, we need to prepare for the word that it might take up to 9 months.
Yep.
That's what you're saying. And then not telling our team that, you have more than 3. Because then I feel like it might also cut down on their productivity. Because now they think now they have more time and they
Right.
will not get it done in the duration
Yep.
that we were to get it done.
Right. Well, and I think where you have to also, when you tell people that, because on one side, you don't want to hide, you don't want to lie to people. But when you're saying your goal is 3 months, we're putting 9 months, because we know A, B, C, D, or E could happen. And so by telling them I'm doing that so that we can ensure that we have the correct funding. So I'm not saying I'm not trusting you. I'm just recognizing that something else could happen, but we still need that 3 months, because something will happen. The problem is we just don't know what that thing will be. So yeah, you don't have to lie to them, but it needs to be so that they understand why you're doing that. Because it's not that I'm not trusting you. It's using my experience or using your experience that something's going to happen. I just don't know what. And if it doesn't, awesome. Everyone's, better off, but I've not seen that happen. So we're actually at questions. So was there some popped up? Did someone online?
Is it a good idea to also account for if creating services for them, say Workday, Drive, etc.
Do they mean for pay, like for, you mean from a, like a salary perspective or how much you pay people? Or is this a productivity?
They also
Pardon me?
they also said so one can decide later on if one should continue to switch to a paid service.
Okay. So you're talking about almost like a buy sell or a rent versus buy type of thing. So it sounds like, should I have an employee or should I do a contractor? Those are actually really good questions. I think in the beginning, it's hard. The decision you have to make if you want to bring on employees versus contractor has to be one. A lot of times we will do I have done the software, kind of temp to full time because it's an opportunity to make sure that's the right fit, that they're the right person for you. The other thing is depending on the specialty, especially if you have something that's very specialized and you're not sure you need that role forever and ever, that might be a good opportunity to use as a contractor or as a kind of a temporary, because the expense to hire and then let someone go or hire someone and have them not being truly productive is extremely high. So I think it has to be, what's your comfort level? The other thing is, that's the other thing, is you have to know what your comfort level is from your cash flow in to make, because if you hire someone, you have less flexibility. I mean, you can obviously let anyone go at any time. I mean, Pennsylvania's an at-will state. You can quote unquote, terminate, but you don't want to get in that reputation. So if you're unsure, sometimes that's where contractors or temp agency companies, can be a benefit from there to make sure like you're comfortable with, this is what I can afford. And then maybe when you get to the point where I know where my revenue's coming from, I'm more comfortable with it, I can then hire people full time. So I think, to me, it's that balance of, is that a position that I need, and can I afford to pay that person on a continuous basis? So,
Makes sense. When a startup is just starting out and they're building their company to have success fee-based contracts with individuals instead of hiring them full-time or, potentially giving the contract to an entirely different entity to run that service for you.
So the question was regarding, kind of if you bring in a contractor, if you bring in a third-party group and have success fees, versus an employee. I think, yeah, you have to do the analysis on all of that. And on the success fees, what you also have to be very, wary of is, if you have employees and you have contractors, you want to make sure your current employees are incented just as much as the outside. So if you have an outside group having a success fee, then their hourly rate should be lower, and vice versa. So I think it really has to do with who you're looking at and what you are comfortable with regard to your cash flow, looking at what you have from a people standpoint. I personally, I've seen it go both ways. And sometimes those success fees, they actually want some ownership. So you have to look at dilution. Do you want that? So it's hard for me to say which one. You have to really look at it case by case.
Hiring someone, then it's a continuous payroll that they're on.
Yep.
As against that, if I have someone on a partial retainer basis, I can
Yep.
afford to not be.
Absolutely. And so when you're looking at bringing a contractor on, each contractor is going to have their own way that they want to be paid. Some want lower amount with a higher bonus, and so that has to be your negotiation. And so you're correct. All I was referring to is if you have current employees and you're looking at contractors, you just want to make sure that there's a balance between the two. And absolutely, that's why I think a lot of companies early on, especially contractors, make the most sense, because you probably aren't ready for them to be full-time. You have a project that needs to be done. And once that's done, you may need to bring on other people from a maintain, but the person who the skill set needed might be more expensive to keep on, and you don't need that anymore. And we had, for example, we had to let someone go because we were like, we don't need more of the machine learning. We needed more software development and data and analytics. So we let that person go because we didn't need that. I mean, we had one without, we were overloaded there. So, right. Yep. So just quickly going through, I mean, I think we talked a lot about, whoops. So we took, the question about hardware, software, different. So hopefully what you saw is I've literally worked in, other than regulated companies, I've worked in every type of company. So this started when I was in an engineering and construction company. That was where my weekly thing started. So then I've been in AI companies, pharmaceutical service, so everything I showed here can be done in any type of company. I think at the beginning, you just have to sit back and understand what your costs are from people, from the any raw materials. That's what you have to understand is those costs. And on the regulated company, for any company that is regulated, that is a challenge. And that challenge from a forecasting, because I've been in when we were at Respironics, we weren't a regulated company, but we had to go through the 510(k) process. So we had a product, it was great. And then you just sit back and you wait to your lot, you can sell it. So if you're in those type of companies, those are the elements things that you have to build in, because you got to figure out, what do I do to earn money between the time that I've made the product and I'm ready to sell the product? Can you do some consulting? Are there other ways that you can have revenue coming in? So that's the challenge. It's the time. And how do I get from here to there? Because I don't want to fire everybody, but I know I'm going to have 6 months of little revenue. So I need to make sure I have the runway and I have the cash. The time to sell versus invest. So one of the things, and one of my companies, here's a great example, is we were looking at, do we want to do, and this is not a sell, but it's a similar, we were looking at bringing equity versus a convertible debt. Well, we were introducing a new product and we were not even to market yet. So the problem we were going to have is if we had done an equity, we would get no value for this new product because there wasn't proven value to it yet. But at least with debt, we could control, like, the percent owned. And once this product became profitable, maybe not even profitable, but once it was in demand, well, gross margin profitable, then our value went up. And so when we did the fundraise or the equity raise, the dilution wasn't as bad. So what you have to look at when you're looking from time, whether it's to sell, to bring in equity or bring in a convertible debt, you want to understand the valuation of your company. One company that I had, this owner, one of the things he shared with me, so I'd worked with him in a second company. His first company, his big lesson learned was every time they got to the next step, he was almost running out of money and he had to keep bringing in more investors. So what happened was, by the time he sold the company, he made a few dollars, but he didn't make a lot, because every time he had to bring in more money, the valuation just wasn't there because they were just ready to start selling the new product. So what he learned early was kind of had I don't want to say a consulting side, but he did two things. One, he partnered with a potential customer to help in development. So therefore they gave money up front. And when we sold them product, they took it at a discount and we had some other revenue coming in. So that's where the timing has to look, is what is the highest valuation? And that's where understanding that runway and going forward, because you'd rather bring in as much money up front when that's the least dilutional versus when you have to, because usually when you have to, you'll sell it for anything and you're going to get diluted. I saw you had your hand.
And I just got out of my finance class, so I'm going over future cash flows. Is that kind of where you had to create projections on like what the enterprise value would be, and then taking consideration like debt versus equity?
Yes. I mean, we do a lot. Yes. I use Carta. Carta is a way to, it's a software where you can put all your shares in, and they'll do an annual valuation. So that makes life a little bit easier. I don't have to go out and hire a third party to help do the valuation. And going through that process, they look at your industry, your market, where it is. So that helps in one side to see where that valuation is. The second thing is going through all of these forecasts and understanding what the timing of when we think new products are going to be in place. When do we think I'm going to be able to be profitable? So probably in many cases, because it's only 18 to 24 months, I will be very truthful. I don't spend a lot of time doing a net present value. I'm just being truthful on that. Only because I'm doing a cash flow. And because think about it, I'm not the one doing the investing. They're doing the investing. I need the cash. And so I have to figure out what's the cheapest way to get in my cash. So I'll look at so if we bring in cash, then we look at, well, what's the dilution to the owners? So me as a CFO, I'm like, I just need money. I just need $1 million. Give me $1 million. I maybe if I'm not the owner, don't care where it comes from. So the current investors and new investors, they're the ones who are probably a little bit more focused on that. And that's when we're looking at like the timing of when is new products, when is profitability coming. So I'm just being very truthful.
I think just like why you're finding it so important, but just like learning about how you will look at it within the company versus like the outsider.
Right.
How their investments are doing.
Exactly. No, that's exactly right. And right. They're going to look at it because they need to understand. They're deciding, am I going to invest in this company or this company? Which one's going to get me the better return? I'm saying I need the $1 million to get to that next level of profitability. My options are, do I want to pay 8 to 10% interest, or do I want to dilute ownership? That makes sense.
In your experience.
So I've not been, well, I guess I've been involved with acquisitions within the company. So yes, I mean, yes, but I'm probably taking it more of the view of the CFO trying to grow the company. Yeah. And then the founder exit strategy. So I think the biggest thing, and I think these are all tied together, when you're a founder and you're looking at exit strategies, I'm the person that you always want to have a plan, but you just have to realize that the plans are going to change. And so I think it has to be that understanding. And the thing is, the plans may change because you may change. You might be like, I'm done. I worked with someone he's like, I'm done. I don't want to do this anymore. So I just want to sell and get, and that's fine. Someone else might change it to, you know what? I like where it is right now. This is lifestyle. I don't need to do any more acquisitions. I just want to enjoy my life. I'm going to hire a CEO. I'm becoming chairman of the board, and you run the business and I'll come in and check. So what you start with and what you end with most likely are not always the same. But when you do start, you want to have that plan because there is an exit. There will be an exit. You just want to make, and that's where at some point, it's working with your tax advisors, working with others. So it's hard for me to say which one, but you just have to recognize. And I feel like this is one of those things, it will reveal itself as you go through the journey. I know we went over. I appreciate all of your time. I'll be around if you guys have any other questions. I assume, yeah, they get all this information. So this will all be there. You can feel free to play around with the spreadsheets. You can probably break them too, which I'm fine with them. But I appreciate all of your time and coming with me today. Thank you.